Hello and welcome to the Pilot Money Podcast. My name is Alex Tapia, President and Founder of Aviation Retirement Strategies and ARS Private Wealth. Together, we give you the tools and advice you need to take advantage of the ever-changing financial world and help you take care of the business end of your professional aviation career. As financial fiduciaries, we bring you up-to-date, relevant, and independent information so that you can make sound financial decisions for yourself, your family, and your eventual retirement from the airlines. Don't forget to hit the subscribe button so that you can stay up to date on any timely information that we bring to the professional aviation community. Or you can also visit us online at www.pilotmoney.com. Once again, welcome to the Pilot Money Podcast. Hello, everybody. Good morning, good afternoon, or good evening, wherever you are in the world today. My name is Alex Tapia. Thanks for joining me here at the ARS National Headquarters at the George Bush Intercontinental Airport here in Houston, Texas. And welcome to the Pilot Money Podcast. American Airlines announced it's going to be offering a market-based cash balance plan to its pilots starting in 2026. Should you be in it? Should you not be in it? What's it all about? And we're going to talk about it in this video and give you some perspective that you need in order to make the right decision for yourself, your family, and your future retirement goals as an airline pilot. So the market-based cash balance plans came into existence because pilots are just making a ton of money now with the pilot contracts that are currently in place at pretty much every major carrier. And contractually receiving 17 to 18% of your gross income is literally unheard of in any industry that I know of, and it's an amazing problem to have. However, it's making it so that pilots are reaching all of the IRS contribution limits before the end of the year, specifically the IRS 415 limit, and that's the limit for contributions from both you and the company. So what happens then? Well, if you don't have another option, basically once you hit these limits, the company has to start paying you on an after-tax basis, as is currently the case at American Airlines. So the market-based cash balance plan is just another avenue for you to put money away tax-deferred beyond these limits, and this can be beneficial when you're in a higher tax brackets. But the real question is, should I participate in this thing or not? Well, the answer really depends on your specific situation. Some things to consider, starting with probably the main one, is which stage are you at in your career, or in other words, how far are you away from retirement, and what tools have you built up in your tool bag already to help you properly cash flow your retirement investable assets. As you go through the process of making this decision for yourself, it's absolutely crucial that you keep in mind that as pilots, we have a lot in common. We like the same things, we have the same interests, but as soon as we step outside of the cockpit, our lives, especially our financial lives, are literally as unique as a fingerprint. So it's important to keep that in mind because what somebody else does or what somebody else chooses not to do really has no bearing on your individual financial life, whatever opinion somebody gives you. As professional financial advisors, we cringe when we hear other people say, well, our opinion is this, say on the Roth conversion or a post-tax 401k contribution, for example. Pilots are, as a whole, a pretty bright bunch of people. And if you are provided all the information that you need to make a decision presented in a logical, easy to understand, and objective way, and in that case, you can make the right decision for yourself and your family. Here at ARS, our job as professional financial planners and professional financial advisors is to do precisely that. So let's break this thing down, help you make the decision for yourself, whether you want to commit to having money go into this plan for the next 3 years or have money paid out to you after tax and invested yourself. So let's start from the 35,000 foot level and work our way down. So the question is, should you be participating in this plan and let the company manage your money for you in a more conservative fashion, or should you just take it as a paycheck, pay taxes on it, and invest in yourself and hope that you will do better? Well, the answer to the question is really mathematical and it largely depends on your tax bracket. You have to realize that if you are at a point where the company is maxing out your 415 limit by the company contributions, you are making a lot of money. More than likely, you're probably in the 40-ish% tax bracket, which is a very high tax bracket. So when you take a taxable investment and you're going to invest it yourself, you have to pay that tax. Well, let's take, for instance, a $10,000 investment. And at $10,000, before you can invest it, you have to pay $4,000 or 40% in tax on this investment. Well, in order to win at the game that you're trying to play, you have to take that $10,000 and you have to overcome the tax bill that you've paid, meaning the $4,000, before you can start winning at it. Well, a $4,000 return on a $6,000 investment is a 67% rate of return. Now, I hope you can get that pretty quickly, but more than likely, it's going to take you a little while to get that kind of return. As opposed to the other, if you take a $10,000 investment and you tax defer it and then invest it, Well, you don't have to pay the taxes. You don't have that $4,000 to overcome, meaning that if you actually get the same kind of return, 67% rate of return, you will actually now be at $16,700 versus just breaking even at $10,000. It's much more effective and much more efficient if you are willing to do that. Because in the financial world, money makes money. A 10% return on $100,000 is $10,000. A 10% return on $1,000 is only $100. So money makes money in this world. So you have to keep that in mind when you're making the decision of whether you want to do it yourself or let the company do it, but on a tax deferred basis. Now, in terms of tax deferral and not having control over your money, one of the arguments is that, well, I don't want to have too much money in this plan and have be so conservative because it's going to hurt the overall performance of my entire portfolio. Well, the answer to that is if you do want to tax defer money, if you don't want to pay the taxes on the money today, what you can do is because that money is going to be a little bit more conservative, you can look at your entire financial picture as a whole, as one portfolio, and make the adjustments necessary elsewhere to accommodate for the funds in the market-based cash balance plan being a little bit more conservative than others. You could, for instance, do that in your 401k through your brokerage like Link account and Fidelity, or you can do it in other investments if you have outside investments on an after-tax basis. Whatever it is that you might have, you can make changes to the portfolio for them to be more aggressive somewhere else to make up for the conservativeness of the investments inside of the plan at American Airlines. I would think probably one of the biggest deciding factors whether or not to participate in the cash balance plan at American Airlines is your age and the stage you are in your career. Now, if you're a young pilot and you're just kind of starting out, you're probably not making all the big money just yet. You will soon, but just not quite yet. And you're in the beginning of your career, and you've got a long time to go before you turn age 59 and a half when you can get the money out of this plan. It may not be the best idea for you to participate in it simply because it's just you have no control over it. It's going to be a lot more conservative than you probably need to be, especially when you're a younger age. When you're a younger age, as you know, you probably want to be a little bit more aggressive because you've got time to go through the market ups and downs versus when you're a little bit older and you're nearing retirement, where you can't really afford a market downturn. And one thing to keep in mind as a pilot, if you're older, your career is finite. There's a definite limited amount of time in which you can take advantage of all these great benefits that you have because at 65 you have to retire unless they change the age, but it's not going to be that much longer. So your age is a big consideration whether you want to participate in the plan or not. If you are a little bit older, maybe let's say 45 to 55, certainly in your 50s, you have to understand that whatever money goes into this plan, you're going to probably it's probably going to be a little bit more conservative, but you probably also have assets elsewhere that you can adjust, like I said earlier, to make up for the conservativeness of the portfolio. And more importantly, when you turn 59 and a half, you can take this money out and put it into an IRA and do whatever it is that you want with that money, and you can be as aggressive as you want to, and you can have full control over the assets. But I would say that the age, if you're younger, you may want to think twice about participating in a plan like this. Maybe wait till you're later in your career. But if you're later in your career and the end is in sight, this is really not a bad place to have tax deferred money because it's going to grow better and you're going to have the ability to take it out when you're 59 and a half, which is kind of like winning on all ends when it comes to having a plan available like this. Just like you, I listen to podcasts and I listen to my peers and I listen to what people are saying out there, and I especially listen to other people that are giving financial advice, especially to this demographic. And you'll generally get this from people that are selling life insurance or selling, basically not really managing money or really not being professional money managers. They tend to tell you that there's a tax tsunami coming and this is like the worst thing ever. That don't tax defer money, put it into a Roth IRA or put it in some life insurance policy and whatever the sales pitch may be. But the reality is that at the end of the day, when you're retired, you want to have as much money as possible. And tax deferring money, although it's not for 100% of your money, but it's a nice tool to have to be able to build wealth and to be able to have options when you are retired, where you're no longer going to get that big paycheck as an airline pilot, because after 65, you're very, very hard to find a job that's going to pay that kind of money. In fact, it's more than likely going to be impossible. So the more money that you have in retirement, the more options that you have. And from a professional money management standpoint, there are techniques that you can use to mitigate your taxes while you're in retirement. And these are things that you can start working on while you're still working. Like, for instance, opening up an after tax account. If you use the right types of investment in these types of accounts, they're a very, very effective tool in mitigating your tax bracket down the road. And also, there's charitable things that you can do. There's estate planning techniques that you can do. There's other things that are available to you that you don't have to commit today to paying to prepaying the IRS the taxes that you're hopefully trying to avoid in the future. You can basically not pay the taxes today and have more wealth and more options when you do retire. When you go about making decisions of whether to participate in a kind of a plan or not, what the most important things to do is to understand that there's no right or wrong investment. There's no particular thing that you're trying to avoid in the future. Nobody has the crystal ball. Everything has its place in this world, and it's up to you to take advantage of what's being offered to you. As an airline pilot, it's a privilege to have the kinds of benefits that are available to you. Whether you're under APA or ALPA or any kind of other union, they've done an amazing job of negotiating these great benefits for you. But what you have to do is just take all of these pieces of the puzzle, in which there are many, and basically arrange them in such a way so that they fit together and they make make the puzzle picture look like what your financial life should look like based on your own individual goals and objectives that you have for yourself and your family and for the longer term in retirement. The cash balance plan at American Airlines is definitely unique, as it is with Delta. They all have their own different nuances, but basically they accomplish the same thing. But what it is basically just another tool in your toolbox to be able to take advantage of should you choose to do that. But is it really a fit for you? Well, that really depends, like I said earlier, on your personal situation. If you want help finding out whether it is something that you should be participating in, to what extent should you be participating in, give us a call. We're happy to help you through the process to be able to make your financial life as effective and as efficient it can be, not only today, but especially when you get to retirement, where you have to properly start cash flowing your portfolios, which is complicated in itself to do it properly based on not only keeping in mind performance, but also for taxes and all the other things that you have to keep in mind when you're retired. Give us a call and we can help you walk through that process. But for now, thank you for listening. If you have any questions, again, just give us a call. It's www.pilotmoney.com or 281-272-2229. That's our phone number here in Houston at our main office, or toll free is 1-888-272-7201. Thank you for listening. If you have any questions, feel free to give us a call. Either way, best of luck to you, and we look forward to seeing you on the line somewhere.